Growth stocks. These are shares in companies that reinvest almost all of their profits back into expansion. Instead of paying shareholders, they pour money into research, new products, hiring, and entering new markets. The goal is to grow the company as fast as possible. Amazon, during its early years, operated this way. So did Tesla and Netflix when they were still proving themselves. Investors buy growth stocks expecting the share price to climb significantly over time as the company becomes larger and more valuable. The trade-off is volatility. Because these companies are moving aggressively and taking risks, their stock prices can swing dramatically based on quarterly results or market sentiment. There are no dividend payments. Your only return comes from selling the stock later at a higher price. Growth stocks work best for people with time to wait and tolerance for price fluctuations. Value stocks. These are shares in solid companies that the market has temporarily underpriced. The business is profitable and functional, but it's not generating excitement. Maybe it operates in a boring industry like insurance or manufacturing. Whatever the reason, the stock is trading below what the company's fundamentals suggest it's worth. Value investors look for this gap. They buy when the price is low and wait for the market to correct itself. Warren Buffett built his wealth using this approach. He identified overlooked companies with strong earnings, purchased large positions, and held them for years. Value stocks don't move much day to day. The returns come slowly as the market eventually recognizes the company's true worth. This strategy requires patience and analysis, not quick reactions. Dividend stocks. These are shares in companies that distribute a portion of their earnings directly to shareholders on a regular schedule. Every quarter or sometimes monthly, the company pays cash per share owned. If you hold 100 shares of a company paying 50 cents per share quarterly, you receive $50 every 3 months. Coca-Cola, Procter & Gamble, and many utility companies operate this way. The dividend yield tells you the annual payout as a percentage of the current stock price. A 4% yield means a $10,000 investment generates $400 yearly. People nearing retirement or seeking passive income favor dividend stocks because they provide steady cash flow without needing to sell shares. The downside is slower price growth. Companies paying dividends are using capital to reward shareholders instead of funding aggressive expansion. Blue chip stocks. These are shares in large, established corporations with decades of stable performance. Microsoft, Johnson & Johnson, Walmart, and similar giants fall into this category. They've survived multiple recessions, adapted through technological shifts, and maintained profitability across generations. Their products or services are embedded in daily life. Blue chip stocks offer reliability rather than explosive growth. The share price increases gradually over time. Many also pay dividends. Investors choose blue chips when preservation of capital matters more than dramatic gains. Retirement portfolios often hold significant blue chip positions because these companies are unlikely to collapse suddenly. During market downturns, blue chip stocks typically fall less than smaller or riskier alternatives. They represent the foundation of conservative long-term investing. Penny stocks. These are shares trading below $5, often below $1. They're usually tied to small, unproven, or struggling companies operating outside major exchanges. The appeal is mathematical. Buying 10,000 shares at 50 cents costs $5,000. If the price reaches $5, that position becomes worth $50,000. This possibility attracts speculative traders. The reality is far more dangerous. Most penny stocks are cheap because the underlying business is weak, poorly managed, or outright fraudulent. Trading volume is often thin, meaning you may struggle to sell when desired. Price manipulation is common because fewer shares and participants make it easier to artificially inflate or crash the price. Some penny stocks do succeed. The vast majority do not. Financial advisors generally classify penny stocks as speculation rather than investment. Only money you can afford to lose completely should enter this category. Cyclical stocks. These are shares in companies whose performance rises and falls with economic cycles. When the economy expands, consumers spend more on cars, travel, construction, and retail goods. Companies in these sectors see revenue increase and their stock prices climb. When recession arrives, discretionary spending drops first. People delay car purchases, cancel vacations, and postpone home renovations. Cyclical stocks decline accordingly. The automotive industry, airlines, home builders, and luxury retailers all follow this pattern. Investing in cyclical stocks requires economic timing. You buy when you believe expansion is beginning and sell before contraction starts. This makes cyclicals more complicated than buy and hold strategies. Getting the timing wrong means holding stocks that underperform for years or selling too early and missing gains. Defensive stocks. These are shares in companies selling essential goods and services that people need regardless of economic conditions. Utilities providing electricity and water, healthcare companies, consumer staples like food and hygiene products all operate in defensive sectors. During recessions, people still pay electric bills, visit doctors, and buy groceries. Revenue for these companies remains relatively stable. Their stock prices don't surge during booms, but they don't crash during downturns. Investors use defensive stocks to reduce portfolio volatility. When the broader market falls, defensive positions typically hold value better than less sensitive ones. They're not exciting, returns are modest, but they provide ballast. Many financial advisors recommend increasing defensive stock allocation as investors age or when economic uncertainty rises. ESG stocks. These are shares in companies evaluated not just on financial performance, but on environmental, social, and governance criteria. Environmental factors include carbon emissions, renewable energy use, and waste management. Social factors cover labor practices, diversity, and community impact. Governance examines board structure, executive compensation, and shareholder rights. The ESG category emerged as investors increasingly wanted portfolios aligned with personal values. Some ESG funds exclude tobacco, weapons, or fossil fuel companies. Others actively seek businesses leading in sustainability or social responsibility. Performance varies widely. Some ESG stocks deliver strong returns, others lag. The label itself doesn't guarantee financial success. Skeptics argue ESG criteria are subjective and sometimes used for marketing rather than meaningful change. Supporters believe long-term value correlates with responsible business practices. Either way, ESG investing has grown substantially and now represents trillions in managed assets. IPO stocks. These are shares offered when a private company sells stock to the public for the first time. The initial public offering allows early investors and employees to cash out while raising capital for the company. Media coverage and investor excitement often surround high-profile IPOs. The stock price frequently jumps on the first trading day. This creates the impression of easy profit. The reality is more complex. Company insiders and venture capitalists typically bought shares at much lower prices months or years earlier. Retail investors buying on IPO day are often purchasing at peak hype. Many IPOs fall significantly within 6 months as initial enthusiasm fades and actual business performance becomes clear. Some IPOs grow into dominant companies. Google and Amazon both went public and later became worth hundreds of billions. Most IPOs, however, either stagnate or decline. Experienced investors often wait several months after an IPO before buying, allowing the stock to settle and reveal its true trajectory without hype destruction. Preferred stocks. These are a hybrid between common stocks and bonds. Preferred shareholders receive fixed dividend payments before common shareholders get anything. If the company faces bankruptcy, preferred shareholders have priority over common shareholders when assets are distributed, though bondholders still come first. Preferred stocks trade on exchanges like common stocks, but behave more like bonds. The dividend is usually fixed, so the price stays stable. There's less potential for price appreciation compared to common stocks. Companies issue preferred shares to raise capital without diluting common shareholder voting rights, because preferred shares typically carry no voting power. Investors seeking steady income with slightly more security than common stocks sometimes choose preferreds. They're less popular than common stocks or bonds, occupying a middle ground that appeals to specific income-focused strategies.